Today's show is going to give you a lot to think about.
When you used to think energy, you used to think oil. Now, electricity is the new oil because electricity is what's going to drive the economy forward because AI needs electricity, reliable electricity, 24 hours a day, 7 days a week, 365 days a year. And so that's why we think at Tortoise, electricity is the new oil. And that creates a lot of opportunities in energy in general because we think that natural gas and nuclear will really be the primary fuel sources to drive that electricity demand going forward.
That's Rob Thummel, Senior Portfolio Manager at Tortoise Capital. And in today's market call, he not only says that electricity is the new oil, but he talks about how some Bitcoin miners, of all things, have become new energy plays. But you want more to think about? Rick Pitcairn, Chief Global Strategist at Pitcairn, a firm that specializes in building investment plans designed to last decades and half centuries, talks about the importance and the value of being fully diversified now, not only because international and hard assets are doing well, but because filtering out the noise can make you a super accumulator. Plus, Lester Jones, chief economist of the National Beer Wholesalers Association, is here, and I'm afraid he's crying in his beer because the latest Beer Purchasers Index is at its lowest levels in history, indicating that there's a beer recession, which could have a hangover effect on the rest of the economy.
Okay, I'll give you a chance, but you better be good.
Oh, I'm not worried that we've got a good show today. This is Money Life for September the 3rd. We're sorry that we're up late for you, but I promise this show worth the wait because we are going in really interesting directions. You know, you haven't heard a lot of experts talking about a recession, but Lester Jones says there's a beer recession, and the Beer Purchasers Index is a forward-looking index because if they're not buying beer right now, it portends what could be happening during the holiday season. And if you have a bad holiday season and consumers are struggling and they're not going out to consume beer and they're not buying beer in other cases, well, what else are they not buying? And what is that going to do to the economy? So you've got that. Then you've got Rick Pitcairn talking super long-term strategies and the ability to both play to what's happening now, but also to not get bogged down in what's happening now. It's a really important message, kind of an interesting interview that mixes the current events with the long-term perspective. And you might go, okay, but Pitcairn deals with ultra high net worth individuals. That's not me. So I'm not that guy. And yet I'm about to open an account for my new grandson that I'm hoping is going to be a 65-year investment. And I have things that I've held in my portfolio for decades. So to say, oh, you should not have this ultra long-term view, that might be literally short-sighted. And then Rob Thummel here for the market call. And oil used to be the commodity that drove the market. He says energy is the new oil, but he's also running a fund that is not just energy infrastructure, it's what they call AI infrastructure. So we'll talk a little bit about the energy infrastructure stuff, though he's going to be back on Friday talking in the Navigator because he also runs a closed-end fund that is in that space. But we're talking a mix of AI infrastructure and energy infrastructure today with specific names and stocks, because that's what we do in the market call. And then Friday, we'll dig deeper into the energy infrastructure side and the opportunities he sees there. I'm Chuck Jaffe, financial journalist, your host here on Money Life. You know what the show's about, and if you don't, well, welcome to our audience. Please get involved. Let us know what you think of what we're doing. Let us know how we can make the show better. Chuck at moneylifeshow.com is how you reach me, and I would love to hear from you. But right now, I want you to hear from our guests and take this one in because, man, really interesting takes in each interview today. We'll start the talk by cracking a beer with Lester Jones when we come back right after this message.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
We start today's interviews opening a cold one and talking about what the survey said. Yes, this is the survey said on Money Life. It's where we talk about surveys, studies, polls, any kind of research or data. It's going to help us understand what people are doing for, with, and about their money. And yes, we are opening a cold one because we are looking at the latest beer purchasers index out from the National Beer Wholesalers Association. And this is a forward looking indicator because, well, beer wholesalers, they're selling for people for what their future demand is going to be. And the numbers, well, there are definitely seasonal trends in beer like there are with the economy, and they are showing up in the index. Here to discuss it is Lester Jones. He is chief economist at the National Beer Wholesalers Association. If you want to learn more, go to nbwa.org for more information. And we do have a link directly to the Beer Purchasers Index details in our show notes. Lester Jones, welcome back to Money Life.
Thank you very much. Good to be here. Sad occasion for the index, but it's still good to be here chatting with you.
Yeah. So let's talk about just how sad the occasion is, because the numbers kind of fell off the table, and they didn't just fall off the table, relative to what we saw a month ago. It's also compared to last year. So this is significant, but how much of this is seasonally significant? How much of this is something bigger is brewing, if you get the pun?
Yeah. Well, listen, so we've been doing this index for over 10 years now, and this is, quite frankly, the lowest number I've seen for the aggregate number in terms of what our members are telling us they're going to be ordering, more, about the same, or less. And the vast majority are telling me less. And we've had a pretty slow summer selling season for the beer industry, and it's multiple months. So if I were to be a member of the NBER, the folks that track the economy and business cycles, I'd have to say, we're solidly in what I would call a beer recession. It's been months over months that we've had less ordering coming in. We've seen sales decline. If you look at employment's down. If you look at wages are down. They're all the economic indicators for this beer industry are telling me, man, if I was benchmarking business cycles, I would have to say we're solidly in a down cycle for the U.S. beer industry. And this is our August number. So the beer industry is incredibly cyclical. We sell, the vast majority of our beer sells from June, July, and August into September. Oktoberfest is great, but it's just not as hot, and we're just not drinking as much for liquid refreshment. So even though we love Oktoberfest, we love pumpkin beers, we love Vienna lagers and all those great, beer festivals that happen in the fall, they're just not enough to move volume forward. So there's no doubt in my mind, and the data are very clear that, this was a bad month for us in terms of ordering beer in anticipation of selling more beer.
Yeah. And by the way, it's not just Oktoberfests. You got football and all the rest, the return of football, not enough to make this be better as well. How much, if any of this, is tariffs? Because while we are looking at domestic beer wholesalers, they are selling international product in some cases. So what are we seeing in terms of the action, and is some of this tariffs coming to roost?
There's so much going on, I think, in the economy right now that includes tariffs, that includes the tight labor market, that includes inflation, that includes shifting consumer demand. The data seem very clear in terms of, with the tight labor market, the folks that are working are making more money. But we're slowly seeing that labor market fall off, indicative of all the economic events that are happening, including tariffs, including immigration, including all those things that are going on. You interview plenty of people about inflation and interest rates, I'm sure. But the reality is in the broader scheme of things, we're still running well above that 2% place where we want to be. So there is a lot of inflation in there. And I think for the people that are continuing to work, they're continuing to go out and spend. But the people that are on the margin are starting to feel the tightness in the labor force, in real wages, and in demand overall. So it's hard to pinpoint it. Yes, we know that tariffs are incredibly disruptive. The vast majority of our beer is sold in aluminum cans, and in aluminum can manufacturing and packaging is pretty crazy, because where you get the sheet metal, where you get the caps, where they all come together, how they come together is a complex international dynamic in terms of, going from raw materials to a final beer can. So that's all impacting us as well.
As you point out, this is worse, and the move bigger and more to the downside. But do we normally expect a bounce back as we get a little closer to the holidays? Like, is there a number that you will want to see that suggests, okay, this was temporary? Do you have an idea of what you're looking for that tells you, okay, now we
do.
have another confirmation of just how bad this is?
Well, it's interesting because we do look at the beer industry mostly from a volume perspective. How many cases of beer, how many barrels of beer, how many kegs of beer? It's very much a volumetric measure. But what we've seen, at least what I've seen in the marketplace in 2025, is a lot of people are spending away from home. If you look at the food and beverage spending data that talk about where people are spending their money, people are spending a lot more money away from home than at home. So what I'm expecting to happen in the fourth quarter is kind of a retreat away from the restaurant, the hospitality, the leisure and hospitality world, coming back to home spending. And maybe for football season, that'll be great. Maybe more people will be spending more time at home, in large family gatherings, watching football. And hopefully we'll see more of our at-home purchases start to go up, which volumetrically, quite interestingly, is higher than away from home. Think about what happens when you go out and have a beer. If you're going to drink a beer at home, you might bring home a 6-pack of beer. You might drink 2. But if you go out to watch the game, it's relatively more expensive, so you might only have 1. So that exchange in volume is pretty significant for the beer industry. And while we've seen a lot more spending away from home, I think in the fourth quarter, we'll see some people coming back home. And I think in that terms, we may actually see some higher BPIs. If we don't get that, I'm going to be very worried in the fourth quarter.
And if we get that, will there be certain areas? Because you look at the index across everything. There's craft beers, there's premium beers, there's premium light beers, there's below premium beers, which if you think we've got a troubled economy, you'd think that the below premium beers would sell more. No, there's cider and seltzer, and everything across the board is down. So is there any specific area that would benefit if the trends you are right are there? When you and I talk again next, will we be going, okay, well, people are spending less, so below premium at home sales are up or something along like, is there one specific area that would benefit more than the rest?
Well, premium lights, just light beer in general, is the largest portion of the U.S. beer industry, and that's where I'd like to see more momentum and some higher ordering rates. But remember, beer distributors hold inventory, so brewers make beer well in advance of when it hits the retail shelves and gets to consumers. You have to do a lot of planning to make this much beer. You got to order barley, you got to have hops, you got to have bottles, cans, pallets, you got to have all these things lined up. So the flow of the supply chain for us is really important. So what I'd like to see is some lower inventories of beer distributors. Those lower inventories are going to be indicative of people buying more beer at retail. Then once that settles, they're going to start calling their suppliers and saying, okay, send me 2 extra truckloads this month because my inventories are low and people are buying. So we're looking at a very slow moving market in that sense, because we have, brewers that have inventory, distributors that have inventory, and retailers that have inventory, and even consumers have pantries, and those pantries fill up as well. So we're looking for equilibrium again in this market. There's a big debate in our industry as whether what's happening right now is cyclical or structural. Is this a new equilibrium for how consumers and retailers and distributors and brewers all work together to get beer to market? Because what we did pre-COVID and what we did during COVID were very radical things, and our market is really still trying to find a new equilibrium, a happy place where we don't like throwing beer out, right? And beer has a shelf life. We want the right amount of beer hitting the shelves at the right time so it's fresh, it's enjoyable, and it's for the right occasion.
Yeah. Well, a loss of equilibrium is something when you really enjoy beer. But when the entire industry has lost its equilibrium, maybe there has just been a little bit of the wrong kind of consumption going on. We will be watching beer consumption because it really is an interesting indicator. Lester Jones, thanks as always for coming on Money Life.
You're welcome. Thank you for having me.
That's Lester Jones. He is the chief economist for the National Beer Wholesalers Association, nbwa.org. For more information, the direct link to the Beer Purchasers Index is in our show notes or on our guest page where you find Lester. Well, You can take a pause. You can take a break, which you might want to do after a beer. But up next, the big interview. Rick Pitcairn from Pitcairn is here in a moment.
Did you know that global generalizable robotics represent a $24 trillion investment opportunity? Top robotics and AI companies are actively reshaping industries across sectors. Learn more about capturing this investment opportunity at Vetify.com.
Welcome back to Money Life, where it's time for the big interview on the September 3rd show. Returning to the show today, Rick Pitcairn. He is Chief Global Strategist at Pitcairn. Pitcairn.com, Pitcairn, Pitcairn.com, a really interesting old line financial firm that, frankly, they specialize in working with ultra high net worth, long-term, old kind of money, if you will. But that also brings up a lot of interesting things. You might say, well, wait, where does that apply to me if I'm not that kind of, well, one, when it comes to strategies and looking at macro, wherever you're coming from, you can benefit here. But two, we're going to be able to also ask some questions about super long-term planning, because that's one of the things that they do. Rick Pitcairn, it's great to have you back on Money Life.
Thanks, Chuck. Good to see you again.
Let's start with just your base case for where we are as we turn the calendar into September, the time of year when the markets tend to get rocky, when we are all scared about what could happen in the fall, but when we're also now mostly expecting to have a rate cut. So we've had a year that I don't know that people didn't expect to have the gains we've had. They just didn't expect to get them the way we've gotten them. So are we going to hold them? Are we going to wind up giving something back? What does the rest of this year look like in your estimation?
It's a great question. I think if you go back to April, certainly people didn't think it was going to turn out quite like it as well as it has. We had a heck of a momentum summer. I mean, pretty much any technical indicator you want to look at in this marketplace right now is powerhouse strong. And you've got to hold that against the idea that in any kind of objective valuation sense, this market's pricey. Maybe not so bad if you throw out the Mag 7 and just look at the broader market, but still, it feels over its skis a little. We're coming into September. You could see a pullback, but I always feel like, technical indicators are a little better predictors of the next 4 months than absolute valuation indicators. And, it's hard to fade this market when you have as technically strong a powerhouse as you have right now.
When you consider all of the changes that we've had, a little surprising that we haven't seen as much of the impact of tariffs as people were expecting. Or is it surprising to you? Like, were you thinking we'd see them quickly, or is this stuff that's now coming, that it's what happens next that's more important than what has happened to this point?
Well, I think what we can learn from the episode is investors, particularly this year, get really caught up in the Trump drama and get really caught up with extreme sort of projections out of what might happen. And the reality is often quite different than that. I don't think anybody thought sitting here in August that we'd have Atlanta Fed GDP at 3.2. They thought these tariffs are going to cause stagflation. We're going to have some lower level of economic growth. And granted, the forecasts for GDP this quarter are wide, but I think to get a little less focused on Trump and his style and sort of the hose coming out of Washington, and a little bit hose of information, just fire hose of all this information coming out, and a little more focused on fundamentals, what's going on the earnings scene, and what's going on in terms of maybe the market outside of the Mag 7 and how are they acting, and how are these rates going to have an implication on that. I think that's where we should focus a little more.
I mentioned the fact that you guys work with ultra high net worth clients, and F. Scott Fitzgerald said the rich are different from you and me. Said that in The Great Gatsby, of course, but there is other difference as well, which is for most ordinary investors, they are worried about, sequence of return risk. Are my assets going to last me through retirement? For your clients, they're talking about enough money that nobody's really worried about running out. What they're worried about is funding future generations. How much, when you put this really long lens on, is this a blip, and an ordinary blip? For as much as we want to believe that these times are extraordinary, If you have family wealth that's been on a 50-year plan, well, that family's 50-year plan is different from my 50-year plan that when I started investing with my bar mitzvah money 50 years ago, right? So how much is this just a blip? Like in the super big long-term picture, if you've got enough money, who cares what's going on?
Well, it's an excellent question. Actually, I spend a lot of time in some part of that range because the way that I articulate it is that, if you've got a 50-year time cycle, the general political cycle in this country is much shorter than that. So we focus in on these things that are much shorter. And it really, if you think about it, it's only been a few presidential administrations that have had even an intermediate impact on market returns. And you could say the Roosevelt administration did. You could say the Reagan administration did. And certainly the Trump administration wants to be that kind of administration, certainly in the second iteration of it here for sure. But I think that it allows you to rise above a little of that, which is a little more of a lottery. I mean, you tell me if you want to try to guess what's going to come out of Washington over the next two weeks and why, because it seems really random to me. And focus on investment returns. And you actually, I believe, have a higher probability of success if you keep that longer term focus.
As you consider that super long-term focus, is it simply have an asset allocation and stick with it and occasionally adjust it? Or have we seen things that make it that the way you are allocating money now and the strategies you are taking now are radically different? Like, is the basic investment the same, or has it all been changed because, well, we now have so many other new asset classes and a few different things? And, 50 years ago, nobody knew from crypto.
Well, I'm telling you, I didn't much do 60/40 back in coming out of the GFC. When I was running money in 2011 and 12, I was rolling real assets into portfolios. I still believed that you wanted some sort of international in your portfolio. So I do believe that you ought to hold a lot of different asset classes. Most of our clients have trust structures, and right now there's a big gray area on crypto and certain kinds of vehicles. But I think it's something worth considering. We sort of use the physical form of crypto and gold, and that's been really good for the past few years. I think investors should hold a chunk of that. But I think just the important message is that if you build these battleships out of these component parts and let the market cycles run through them, rather than trying to chase the cycles with your money, yeah, sure, you're going to have periods of time when one asset class or another is out of favor. But over time, you don't have to have that execution risk of timing, and it comes through in your return. And I see it time and time again, where that steady return in the high single digits really does end up being a super wealth accumulator.
Not to take you from saying, okay, we want to have that, to doing things that are a little more granular. But since you talked about international and wanting international, where do you want international right now in a world that has two wars actively going that have had less impact on the markets than we might have expected?
Yeah, it really, if you think about it, I think one of the remarkable things about 2025 that people aren't talking about too much is the fact that we've got the S&P 500 that's up in the high tens right now on a year-to-date basis, something like that. Non-US stocks are twice that. They're like 23, 22, 23 right now, and that's because of the weaker dollar. And I really believe that there's a number of fundamental reasons, another number of government reasons where a weak dollar trend is in front of us, in which case holding things like international equities and commodities are going to be they're going to be money makers for your portfolio.
How uncomfortable is it to go through a weaker dollar trend? Because I don't think that's what people were expecting when they said, oh, let's go put in tariffs and let's do the rest of this. I don't think they recognized what they were asking for.
Well, they may not have, and we've actually had some really strong periods of returns when you've had a weaker dollar, particularly if you have a globally positioned portfolio. If you think about it's just been a while since we've had them. My calculations say dollar strength, dollar weakness sort of runs on 10-ish to 12-year cycles, something like that. We're in year like 18 of a strong dollar cycle. So I think it's time for investors to contemplate what their portfolio would look like in a little bit of a weaker dollar cycle. And I think that there's trade reasons and just fundamental reasons. I mean, we're cutting rates and we got $37 trillion of debt. At some point, the currency's not going to look that great to foreign investors, and it's going to be a reality for us.
As the investor with the super long cycle, at what point do you start to worry? I mean, again, we're looking at a government that is struggling to try to figure out what to do with, say, Social Security, where the time frame's starting to get tight, let alone what they're going to be doing with government deficits that they may not affect me in my lifetime, but my lifetime, well, I hope it's more than 20 years still, but relative to the things that you're doing with some of the high net worth investors, they're looking at longer time frames. So this stuff will come to roost on their watch. When do you start playing that in?
That's a great question. I mean, I'm starting to prepare a speech that I make at our annual client event, and I give them the speech every year for a long, long time. And I think I was talking about this like 3 years ago, how the debt level is just too high. And what series of events convinces international investors to downgrade the value of the dollar? So it's very tricky to time. I think one of the things that you see, if you see the Genius Act that just came through in July, that's Bessent and Treasury saying, maybe we can create Treasury and dollar demand in the stablecoin market because it's sort of going to go away on the international market side to sort of lengthen that out, that moment when, valuations go. And don't get me wrong, I don't think that's the end of the world. I don't think it's okay if the dollar's worthless and it crashes. I just think the dollar's about 30% overvalued, 20-30% overvalued, and that's going to come back over time. And if you have real assets, if you have international stocks along with your U.S. stocks, you're going to make money in that environment.
You talked earlier about the U.S. market and the fact that it has not been broad. Are we getting to the spot where you're going to look and say, okay, since I am this long-term investor and I take this long-term time horizon, well, historically, if you look long enough, small caps deliver better than large caps. But we have not been living in that history for a good long time. And the small cap rallies we've seen have been short and not able to hold it. Are we getting to a point where we have to change our thinking when it comes to small company stocks?
We're doing some work right now on just how much, because you're right. I'm an old creature of the financial markets. And if you go back and look at academic papers that I studied when I was in graduate school and even beyond, they all talked about the small cap predominance, of value predominance. The DFA shop was built on that, basically. That's different today. And you wonder if, one of the things that I see my clients very interested in, and I think the street almost, assault would be the wrong word, but it's close to it, is the sales process around private capital. And you wonder if private equity, private capital, venture hasn't taken some of that investment return that we used to get in the public markets and captured it over on the private market side. So it'll never be available on the public market side anymore. But I think, that's something that my clients have the ability to invest across the spectrum. Some investors right now can invest in private markets. That looks like it's opening up to me, and that'll have come with its own risk and opportunities for clients. But I think that the question really is, where should I be? And I think to have as many asset classes that make sense, run professionally or passive if you need to, and to let the strategy rather than the timing influence those portfolios is a big winner.
We've talked a little bit about asset classes and the rest. How much do you believe we're seeing structural changes? For example, you talked about the companies staying private and how that money may not come to bear. Well, A, we've got more private equity investments than we've ever had before, but B, we have shrinking numbers of stocks. And then the indexes are different than they've ever been. You've got so much money in the top couple of stocks in the S&P 500. Do we need to come up with new tools? And do you, because of that long-term lens, use different tools?
Yeah, I mean, I think that you have to use a different tool when you look at valuation right now because it's been a little tweaked. So yeah, I could be a little bit more forgiving on some of these valuations because you've got a different market composition than you had. And the S&P 500, as an example, which at one point was a more broad-based index, is primarily a technology index at this point, particularly when you compare it to the foreign market. If you bought the S&P 500 as a proxy for U.S. stocks and the EFA as a proxy for non-U.S. stocks, you'd have a triple the technology bet in your U.S. sector than you would in your EFA. Triple might be wrong, but it's close to that. And so you have to take that into account when you look at these long-term valuation numbers. Still, the market's pushed. I mean, Palantir at 110 times revenue is pricey no matter how you look at it. And I was just looking at the Scott McNeely quote, which from 1999, where he talks about how ridiculous 10 times revenue was in conjunction with Sun Microsystems, and we have several companies well north of that now.
We've come this far in the interview, and we have not discussed whether or not you think we're going to have a recession or how long it's been put off. It was all anybody could talk about at the beginning of the year. It certainly became the subject when we got to Liberation Day, when the tariffs went in and the market tanked, and everybody said, "Oh, the odds of recession are up." And now nobody's talking about the odds of recession. They haven't been repealed. There's going to be one that happens at some point. When do you think it's going to happen?
I just don't see it in the near term. If you would have told people, as I said earlier, that in April that the Atlanta GDP model, as we sit here, would be 3.2, 3.5, wherever it is, a lot of forecasts over 2 for this quarter. It just doesn't seem to me that in the short term you're going to have a backup. And if you look, consumer discretionary is really quite strong right now. I think the short-term momentum indicators in a number of different factors look like we're going the other way. We're actually going to global strengthening and U.S. strengthening and not to weakening. There's still some pockets of weakness for sure. Next year should be interesting. I'm seeing these things, some of the things that goes on in these marketplaces, you don't know what to track, but I'm hearing a lot of buzz around a GDP bump off of the World Cup here in the U.S. and bumps in airlines and bumps in leisure-related stocks, because you're going to have so many people coming from all over the world to watch that go on. That would be sort of a leg to push whatever recession that is even further down the road. It's a great question because, as I said earlier, I think that's what's important to investors. Look at fundamentals like this and look at the leading indicators to see, rather than sort of, the latest sort of mini drama that comes out of Washington, which I think for a lot of times is a head fake for investors. It's hard to really direct your portfolio performance.
Well, Rick, thanks for keeping us focused on all the right stuff. I appreciate your time. We'll talk to you again down the line.
It's good to be with you, Chuck. Have a great day.
That's Rick Pitcairn. He's the Chief Global Strategist at Pitcairn. It's pitcairn.com if you are looking for more information on the firm and what they do. We're heading for home on the September 3rd edition of Money Life. Up next, Rob Thummel from Tortoise, Senior Portfolio Manager there. We're talking infrastructure investing in the market call when we come back right after this message. Rob Thummel, Senior Portfolio Manager at Tortoise, is here. We're talking infrastructure investing, and it's market call time. Welcome to the Money Life Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they put it all together. Returning to the show today, Rob Thummel, Senior Portfolio Manager at Tortoise, where he is the president of the Tortoise Energy Infrastructure Fund. The open-end fund is TORIX. The closed-end fund is TYG. Keep that in mind. Rob will be here again on Friday, and we'll be talking more about energy infrastructure then as part of the Navigator segment. But Tortoise also opened a new infrastructure fund and a new type of infrastructure fund less than a month ago. It is an ETF. TCAI is the ticker symbol for the Tortoise AI Infrastructure Fund. If you want to learn more about the firm, its funds, or Rob, go to tortoiseadvisors.com. Rob Thummel, welcome back to Money Life.
Hey, thanks for having me, Chuck. Good to be here.
We always start with methodology, but I don't just want to focus in on like, hey, what kind of stocks are you looking for? Obviously, the definition of infrastructure is changing. You've got a new infrastructure fund. So help us understand first how much we're getting into different granular forms of infrastructure investing these days. And then what are the things that you look for that make stocks in any of those areas stand out to you?
Sure. So infrastructure is just so essential, right? I think we think it's underappreciated at Tortoise in general. We started out at Tortoise in energy infrastructure, and if you think about, well, what is that? A lot of infrastructure you never see, you never hear about, and that's a good thing. So infrastructure on the energy side is really pipelines. The U.S. has the largest energy pipeline network in the world, the largest energy infrastructure network in the world, and it's all owned predominantly by publicly traded companies. So investors can invest in all of this. But you never hear a lot about that because these assets are often under the ground. You never see them. That's a good thing because they don't have safety issues. They're well maintained. But the entire economy, the whole world, runs off of energy. That's a basic fundamental component. Now, hey, now we fast forward and say, well, what's the new world going to be? Well, we're headed into a world where AI is everything. AI is going to basically take over our lives. We'll see how far it goes, but AI is obviously going to become a really important component of the new economy, and AI may become the economy. Well, there's an opportunity then in AI infrastructure. So everybody's heard about the chips, and Meta, Microsoft, Google, and Amazon, who are the big hyperscalers who are building AI applications. But what nobody thinks about is with all of those applications, you need infrastructure behind it. You need electricity. You need data centers, and inside data centers, you need lots of different components. You need electrical components. You need data servers. You need data storage devices. You need cooling. So there's just a lot of infrastructure, all of which are really real hard assets, that in a lot of cases these companies have these big economic moats because it's just really impossible to replicate infrastructure networks that these companies operate.
There has been a lot of talk in the energy infrastructure space about what is going on because of AI, but also about what has been happening because of policies of the current administration. And while I don't want to get into politics, if we don't have enough power generation necessarily for AI now, and we're stepping back from some of the alternative resources, are we setting up a situation where you can look forward and go, I can foresee the boom coming because you've got this demand. And oh, by the way, you're kind of artificially constricting supply?
Yeah, no, that's a good observation, Chuck. So if you think about where we are in the energy sector, I'll be honest, I've been investing in the energy sector for 30 years. I've never seen probably a better time to be looking at investing in the energy sector for some of the reasons that you just articulated. A couple things. Number one, the biggest reason is if you think about it in the U.S., largest producer of energy in the world. We own the largest infrastructure network in the world, largest energy exporter in the world. So there's just a significant opportunity just by itself, investing in the companies that are really continuing to allow the U.S. to maintain this leadership role in global energy. However, now we've got a whole nother component, AI, and the ability for the energy sector to evolve now. And energy sector is evolving in a major way because when you used to think energy, you used to think oil. Now, electricity is the new oil because electricity is what's going to drive the economy forward because AI needs electricity, reliable electricity, 24 hours a day, 7 days a week, 365 days a year. And so that's why we think at Tortoise, electricity is the new oil. And that creates a lot of opportunities in energy in general, because we think that natural gas and nuclear will really be the primary fuel sources to drive that electricity demand going forward.
In terms of what you are then looking for, whether it's pure energy infrastructure or it's the AI energy infrastructure, what are the characteristics that you specifically value and that's going to make one company stand out from another? I mean, how much of this is multiples versus valuations versus cash flow versus debt, et cetera?
Yeah, no, it's a good question. So fundamentally, what we look for when we're looking at these companies outside the evaluation is simply we want these companies, the managers that operate these assets, they're long-lived assets that have long duration contracts, so multiple year contracts that have fee-based cash flows, so consistent, steady margins. In the case of, well, we like to see revenue growth. We see more revenue growth out of some of the AI infrastructure opportunities than we do energy infrastructure, but we get a lot of dividends out of the energy infrastructure versus the AI infrastructure, which is still growing and growing quite heavily. So those are the type of things we like to see. Obviously, we like to see management teams that have a long track record of operating the assets and operating the company and have significant ownership stakes as well. Valuation obviously is ultimately drives our decision making as well. And we just think that when you look at the energy infrastructure side, where the whole world's been talking about how all the stock market, basically all the sectors are trading at or above their all-time averages. Energy infrastructure is not. So we see some value there on the energy side. On the AI infrastructure side, we're seeing a lot of names that, I mean, aren't the chips, and the chips are obviously trading high multiples because of high growth. But oh, by the way, there's a lot of other AI infrastructure names that have high growth but aren't trading as high multiples.
Yeah, the AI infrastructure means that what you're really talking about is you are AI adjacent. You're investing in the companies that are going to benefit because the other guys are doing the chips and the rest. Will you expect, given that AI has proven to be as volatile as it has been, volatile in a good way, generally speaking? I mean, nobody complains about upside volatility, but we've had plenty of it. But do you expect that AI infrastructure can have the same consistency that folks seem to expect from energy infrastructure?
So what we think, so we're just in the beginning stages, Chuck, of this kind of this AI build out. We think, right? I mean, the AI, generative AI started at the end. I think ChatGPT came out in November of 2022. And at that point, I think the hyperscalers were spending about 150 billion dollars a year on let's just call it AI infrastructure. Now, today, just a couple years later, they're spending 300 billion dollars a year, maybe 400 billion dollars a year. There are estimates out there that they get to $1 trillion of capex spend by 2030. NVIDIA, Jensen Huang just came out last week and said, we think that number by 2030 may be $3 or $4 trillion. Well, okay, so what does all that mean? Well, that means a significant amount of capital is going to be spent, and that's going to result in growth rates for the underlying companies that we're investing in that are providing the data storage devices, the network switches, the servers, the air conditioning equipment, the electrical equipment, so on and so forth. They're going to grow at double digits, maybe as much as 25%, maybe as much as 40% every year between now and 2030. And so there's a huge opportunity here, we think, to find value in these stocks. They're growth stocks, but they're still value because they're not reflecting this tremendous growth potential that we could see as the U.S. strives to maintain its AI dominance. And I don't think we're going to lose that.
So let's get down to brass tacks. What is an example or two of the methodology, the kind of thing you particularly like right now?
Yeah, so let's just start on energy infrastructure real quick. We like natural gas pipelines because we think that and natural gas demand's probably going to grow 30% between now and 2030. So you're going to need a lot of volumes to go through the pipelines. The pipelines are classic infrastructure investments, long-term contracts, 10 to 20-year contracts, fee-based contracts. So they just simply get paid. The operators get paid a fee for the volume to go through the pipeline. Often the contracts, the rate goes up with inflation, so they've got some inflation protection. And so the volatility of these cash flows is not high. But the cash flows steadily increase, and so that allows companies like Williams and Kinder Morgan and some of these other pipeline companies to pay really high dividends, yet grow the dividend as well. That's an example on the energy infrastructure side. Let's take it real quickly on the AI infrastructure, and in TCAI, what we focus on is the electricity infrastructure that we were talking about earlier, because electricity demand is going to grow for the next several decades for the first time, really in the last 2 decades, but then also inside the data centers. So data storage devices, if electricity is the new oil, data is the new oil as well, because data is what really drives all of these AI applications. So you need a lot of these data storage devices. So who's the leader there? Well, Seagate. Seagate's a classic example. Seagate's probably got 40% of the market on data storage devices. Well, if you're going to build these massive data centers, which are being built, you're going to need millions and millions of data storage devices. So Seagate's going to continue to grow its revenue at 10 to 20%. They're actually expanding their margins as well, to 35 to 40%, and that then ultimately results in earnings per share growth and EBITDA growth of 25 to 30%. And so, but yet the stock's trading at something like 15 or 16 times earnings. And so it's examples like that we've identified and we think have significant opportunities for investors looking to play the infrastructure theme.
And once you've found those opportunities, what makes you sell, and maybe what's something you've had to move away from?
Yeah, obviously valuation usually sell, or maybe a change in the technology or the location. we've often moved on the energy infrastructure side, sold a pipeline assets or infrastructure assets when it looks like that the drilling economics are a little challenged in one region versus another, and so that would be one of the reasons we sell there. Now, in AI infrastructure, I've only talked about data storage. There are so many things that go into AI infrastructure right now, including electricity infrastructure, including the data centers themselves, including all of the components inside the data center. So we're always evaluating what's the most critical, what's the most essential inside all of this AI infrastructure, and then what's the market rewarding, what's it not. So we're moving around in a lot of cases there. Most recently, actually, this is an interesting one. Actually, on the AI infrastructure perspective, we've been selling some traditional electricity, and you know what we've been buying? We've been buying Bitcoin miners. You say, well, why Bitcoin miners? That's really odd. Well, it's because we're not buying them because they mine Bitcoin. We're buying Bitcoin miners like Riot and TeraWulf because the mega techs want electricity and they want it now. And so what they're doing is they're going to the Bitcoin miners and looking to enter into contracts, long-term contracts, almost a decade in length or longer, to get access to the power supply that these Bitcoin miners have. So effectively, the Bitcoin miners are converting or transforming from Bitcoin miners to data center operators. And so we've seen that happen in a couple cases, and you've seen the stock prices recently of those. Or I would encourage you to look at them. They've had tremendous success because of this transformation. But it's all because Microsoft, Amazon, Google, they're all looking for power and power capacity now, today, not tomorrow, but today.
Now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
It's sock it to me time.
Oh, absolutely. And socking it to us today, Rob Thummel, Senior Portfolio Manager at Tortoise. And yeah, he has been socking it to us if you consider that he was just talking about Bitcoin miners as an energy play. Think about that for a while. And also, electricity is the new oil and more. But now we're going to put him to your test. It's quick and dirty, our lightning round. You know how to get involved. Send your favorite tickers to chuck@moneylifeshow.com, please. But we start today with a request from Scott on Whidbey Island in Washington. He wants to know about Ameren Corp, ticker AEE.
Okay, so Ameren. So I mentioned electricity's really the new oil. Well, there are data centers that are developing all over the country, and so in Ameren's case, their service territory is Missouri, Illinois. There's a lot of data centers that are potentially going to be building out in that service territory. So Ameren's going to see its growth rate of its underlying commercial electricity and its overall electricity growth rate start to increase, and probably increase pretty substantially because of that. So as a result, the Ameren we think is a really good opportunity for investors that are looking for a underappreciated AI infrastructure play with the potential for accelerated growth tied to the development of AI.
So there you go. It's the electricity play with those ties to AI. That's a buy on AEE, Ameren Corp. Richard in Chula Vista, California, and Lance in Bethlehem, Pennsylvania both want to know about EQT Corporation. It's ticker EQT.
Okay, so EQT, we're really excited about EQT. EQT is one of the largest natural gas producers in the U.S. The management there is outstanding. Toby Rice and his team have done an outstanding job of really developing a pure play natural gas operator in the U.S. It's one of the few. And if natural gas and nuclear are the future of energy, like we think, and if you agree with that, and you see this growth in natural gas demand, you're going to need some of the lowest cost producers to provide that natural gas supply. Well, that leads you back to when you start doing the analysis. EQ2 is at the top of the list as being one of the largest, lowest cost producers in the U.S.
Buy it outright.
Yep, buy it outright. That's buy on EQT, EQT Corporation. Our next two requests come from Ted in Cincinnati, and because they're both partnerships in the pipeline world, we'll lump them together. First, Enterprise Products Partners, EPD, also Western Midstream Partners, WES.
Yeah, so these are examples, Chuck, of those pipeline operators with these massive pipeline networks, very difficult to replicate, almost impossible. So they've got these big economic moats, large economic moats that Warren Buffett likes to talk about. You can't replace these the networks, the infrastructure networks that both EPD and Western Midstream operate right now. Now, look, because of that, got high dividend yields, probably 7, 8, and I think in the case of Western Midstream, almost a 9% dividend yield. So these and these companies are generating a lot of free cash flow. So those dividend yields are real, and they're paying this out of cash flow that the companies generate. And so these are really good opportunities for investors looking for high current income. Also, these companies are not trading anywhere close to their 52-week highs as well. So these are companies trading at discounts to where they've traded at historically, and in a market where most stocks are trading at or above their historical 52-week highs.
So they've got room to run, which means...
Don't worry if the price starts going up, just keep buying.
Yeah, that's a buy on both EPD, Enterprise Products Partners, and WES, Western Midstream Partners. Our last request today goes to Stephen in Flower Mound, Texas. He wants to know about NetApp, its ticker NTAP.
Yeah, so similar thing that we're talking about on data storage, Chuck. So NetApp, we need more data storage. We're always going to need more data storage. Data's the new oil. So NetApp is going to be is front and center in the development of data storage. And so if AI is going to continue to develop, data storage is going to continue to grow, and NetApp will continue to maintain its market share in that area.
And so we finish with a clean sweep. That's a buy on NetApp, ticker NTAP.
Buy. Is that all you can think about?
Yeah, we had all buys during Quick and Dirty. And, well, now we've got one more good buy to talk about. It's the one where I say goodbye to Rob Thummel. But Rob will be back on the Friday show for The Navigator. So, Rob, looking forward to that conversation. Thanks so much for this one.
Thanks, Chuck. Thanks, everybody.
Rob Thummel is Senior Portfolio Manager at Tortoise Energy Infrastructure. TORIX is the open-end fund. TYG, the closed-end fund. Tortoise AI Infrastructure, the new ETF, TCAI. Learn all about them at tortoiseadvisors.com. We'll be back to wrap up this show. Stick with us till the end, please.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Thanks for sticking with me all the way till the end. I appreciate it. That was a fun interview with Rob Thummel. I will point out that Rob was just incredibly kind, because we had this issue where basically the 2 interviews that we did with him were recorded last Friday. So we did an interview that was supposed to be on yesterday's show, and then we did The Navigator for Friday, and they both were lost. It was a technical problem. I will point out it was not my fault. So normally it is my fault when something like that happens. This time it was not. It doesn't make a difference whose fault it was. The only question was, when could we get him back on the show? And was he going to be kind enough to sit for 1 or 2 interviews? And he was kind enough to sit for 2. So we will have further energy infrastructure conversation. The one thing I will say is that in having to do it over, when he and I did the interviews the first time, we kept a little bit of the energy infrastructure stuff you heard out of the market call, and instead wound up saving more of it for The Navigator, and we did a little bit more with AI infrastructure. But I still think some really interesting comments about electricity being the new oil, et cetera. So fun having him on the show, and I can't tell you how much I appreciate him. And by the way, we always tell you, if for any reason when we tape an interview, which is usually the day before you hear it, but if it winds up impacting anything, we try to make sure you are aware. That's one of the reasons you should listen to the beginning of the show and sometimes the end of the show to know. So in this case, Rob retaped everything with us on Tuesday. You will hear him again on Friday. And generally speaking, when that happens, you'll hear me joke and say something like, hey, it's been a while. Thanks. So it feels like I was just talking to you. Yeah. Tomorrow on this show, we've got a new guest making their debut in the market call and talking about a subject that I know a couple of you have asked about. Seth Cogswell will be here. He is from Running Oak Capital, and they've got a mid-cap fund. He's the manager, so we're going to be talking mid-cap stocks with him. We added a ton of guests. I'm not going to tell you all about it for us tomorrow, but because it's not all tomorrow, it's stuff that's coming for the rest of the month and into October. But really excited about things that are coming up. By the way, also on tomorrow's show, Todd Rosenbluth with the ETF of the week, and more. Meanwhile, if you're looking for something to celebrate, today is U.S. Bowling League Day. And, well, I love bowling, and I hadn't done it for years. I got back into it a few years ago just for giggles with friends. And I'll tell you, if you haven't done it for a while, go do it. Like, it's something you can do as you advance in age and still be, as bad as you were when you were before, because I wasn't a good bowler before. I'm probably not a good bowler now, but I certainly enjoy myself when Gail and I get a chance to go, and it is something that she hadn't done for many years, and we do it together occasionally, not often enough. It's also National Skyscraper Day. On the food front, an important one, it is National Baby Back Ribs Day. I will actually be working on baby back ribs. I'm not making them till tomorrow, but I will be prepping them, removing the membrane, getting them all set up for tomorrow's cook today. So I'm kind of celebrating. And then also on the food front, National Welsh Rarebit Day. Welsh Rarebit is basically toasted bread covered in a mixture of hot cheddar cheese, beer, although sometimes it's ale or milk, and other ingredients for seasoning. It's kind of like a beer cheese on bread thing. And I thought it was weird, but I also liked it when I was a kid, so I haven't had it in a long time. Maybe today should be that day. My guests today were Lester Jones, Chief Economist at the National Beer Wholesalers Association, NBWA.org, and then the direct link for the beer index is in our show notes. Rick Pitcairn is Chief Global Strategist at Pitcairn. It's pitcairn.com. And Rob Thummel, Senior Portfolio Manager at Tortoise Capital, tortoiseadvisors.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Barry Ritholtz. He did not say this in an appearance on the show, but he did say, good investing is an exercise in humility. We know far less about history than we believe, even less about the world right now than we imagine, and almost nothing about the future. Yeah, and still you have to invest for that future, and you have to do it right, and you have to keep money in its proper perspective. To do that, remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Ta-ta, scones, Benny Hill, Big Ben, yellow teeth, and all that.